Let's work this trade war out from a macro perspective. So China needs oil. They're not going to buy U.S. They go buy Iranian oil. Like, what do you think is going to happen?
They're not going to buy. What the Chinese are buying Iranian oil to put into their SPR. A government company is taking it. None of the commercial companies are going to touch Iranian oil because of the fear of U.S. sanctions.
And so that is very much sort of the geopolitical backdrop that does not necessarily seem to have mattered right now for oil. Well, as you see it, you're a supply and demand guy. What's the balance like right now?
The balance is relatively tight. I mean, that's an amazing thing. Last year at this time, Brent was $75. Mm-hmm. Today it's $60. Yet U.S. commercial crude stocks are virtually the same as last year. That's sort of amazing. And that's because everyone is so bearish 2020 because of the macro environment. You're seeing a slew of new hedging coming on, and that's overwhelming the paper markets and putting downward pressure on the flat price.
So I'm glad you brought that up because we have a chart that kind of shows the seasonality of oil inventories if you come inside the terminal. So the green line is where oil inventories were last year. The blue line is where we are now. We actually look tighter than where we were last year. How much of that do you see as underlying demand? How much of that is, hey, we got some pipelines, we're just moving oil in different locations and we're exporting more?
Well, I think it's mostly supply. The fact that the Iranian exports are down 2 million barrels a day year on year, that the Saudi exports are not any higher than they were last year. So the supply side of the market is relatively tight, despite the fact U.S. production being up over 1 million barrels a day. Demand we haven't seen any demand growth year on year for the last 3 quarters outside of China, which is amazing. But if you think about 25 central banks easing, and if some kind of resolution comes to the trade conflict, then the possibility of demand improving is there. And I think a lot of this bearishness for 2020 could turn out to be wrong. I mean, think about it. If prices are $15 below where they should be based on fundamentals, that means that demand is going to be a lot stronger and supply is going to be a lot weaker than people think 6 months from now, 9 months from now. So that, in fact, we may not see this surplus that everyone was worrying about in 2020.
But it does raise the question of how much oil we're going to need in 2020. That's really the issue here. We think we're going to need less, and that must be affecting the price. How much of that is just driven by trade concerns and therefore global growth concerns?
A lot of it. A lot of it. It's driving everything. It's overwhelming the macro view of the world. And so with the 10-year and the 30-year where it is, that's why oil is so weak. If it wasn't for that, and the Saudis are struggling, they want $70 Brent. They have this IPO next year. They need to get the price up. And they've been undersupplying their customers, and they're likely to continue to undersupply their customers to keep this thing tight. We'll see pretty substantial stock draws on average in the fourth quarter, which should be very supportive. But again, it's a function of the macro environment, the S&P. You can't ignore that.
Well, to pick up on OPEC quickly for that, is that they still seem optimistic about next year. We had the recent Joint Ministerial Committee where they kind of monitor what's going on with OPEC, and they said it underscores the growing importance of the declaration of cooperation in supporting oil market stability, which, along with ongoing healthy oil demand, so far has arrested global oil inventory growth and should lead to significant draws in the second half of the year. It feels like they're pinning a lot of hopes on demand coming in stronger than a lot of the oil producers and agencies think.
I think we're going to get a demand pickup in the fourth quarter because last year the comparisons would be very easy. Last year demand was very weak. It was actually flat year on year. And I think you also have the IMO, the big change to low sulfur bunker fuels. So the refiners are going to have to prepare for that and run a lot more crude oil to make low sulfur diesel fuel and low sulfur fuel oil. So there's no doubt in my mind that you see a pickup in demand in the fourth quarter. And I think pretty much the macro environment is not expecting it. And that's why there's a huge supply of paper, which has overwhelmed the price and kept the price down $15 below really where it was last year and probably $15 below where it should be. I mean, think about all the geopolitical stuff that's going on with Israel and Iran. I mean, the last week, Israel has attacked Iranian proxies in Iraq, Syria, and in Lebanon. I mean, the possibility of a war between Iran and Israel certainly has grown over the past week. And so there's a lot of stuff to worry about, but no one cares about it because of the overwhelming trade frictions in the macro environment.